What's going on, everyone? I hope you're well and doing great as we get ready for today's session. It's got a little bit of different of a tone, a sober tone at that. And the headline is "The Collapse of America Has Already Begun." And true enough, I don't know that America as we know it will ever be the same. And there's a tremendous disconnect between certain segments of the population. Obviously, there is the elite of the elite, or that like to call themselves. Forget the elite. There is the top 0.1%, which is vastly different than even the top 0.5%, the top 1%, the top 5%. You likely and probably know many. And then of course you have the middle class. And this is important because the middle class is obviously and continues to be shrinking. And when we talk about the collapse has begun, it's you know the bottom trench here, and it's below middle class. They are suffering. They are suffering, and it's really a horrific situation. And obviously, it's not a question of resources. It's not a question of resource. I think it's a question of the rich can never be satiated. They always need more. They always want more power, more money. But that's a different reality. We are talking about right now in this moment the very real reality that a lot of people are suffering. A lot of people right now are having a lot of trouble affording the basics, and that's just that, like, utilities, electric and electricity is expected to continue to go up, especially now to feed all of the machines as the great AI race is among us. Nvidia's earnings yesterday were not the best. Surprising to see the market here holding on. We'll talk about that in a little while. I want to continue here, just setting the tone for today's session. And then in today's session, we're going to be looking at, first of all, a lot of what people see. I think that everyone's aware of what's happening around them, and a lot of people are leaning into, let's say, old financial playbooks, and they believe that we're about to experience an imminent collapse. And what I'm trying to say is the collapse has already begun. The collapse has been going on for a long time, and it's going to continue. It's going to accelerate. You could see right now that actually what AI is replacing is a lot of low-level entry jobs at a significant pace as well. And a lot of things that, entry level, out of college, a lot of those jobs can now be filled by these tools that, yeah, they help productivity of those. And I've seen it firsthand. I have a close friend, and I seen he's a fantastic dev. I've seen what he was able to build in a week with one of these tools, with a couple of these tools. And, normally it would take 3 to 4 months in order to be able to produce that amount of work. And of course, going forward, people will continue to look at the progress of this technology. And, people are a little bit concerned, and rightfully so, and worried. It seems that for us, we look at the continued, like, there's one thing that we know for certainty, and that's the devaluation of the fiat is going to continue. It's the only way to keep the debt-based system going. Now, the fear is always one of two things. The fear is always that, are we gonna experience hyperinflation? Or my greater fear, almost, both are absolutely horrific. It would be a deflationary debt spiral. That would end not only America as we know it, but the world as we know it. And it would be absolutely horrific. Both scenarios are horrific. Both, I think, have an extraordinarily low probability of occurring, at least in the near term. Near term, next few years, right? Next 5 years. Beyond that, it's impossible to know what the world is going to look like 5 years from now. It's just absolutely impossible. And, which is why we try to take it as it comes. And normally that's been like a 3 to 3 month window. Recently, a little bit longer, looking at like a 12-month window. Nevertheless, we continue to see advancements that point to a further diminishing of that middle class. I think this is correct. The largest occupation in the United States are truck drivers. And obviously, if you look forward, and I don't know what type of time frame that is, but let's call it 10 years, likely the majority of those jobs have been replaced through automation. And then you look at a lot of people's lifeline. A lot of people's lifeline today is being able to offer Uber services or Instacart or Grubhub. And a lot of people, if they're unable to kind of like make ends meet, they have the ability to actually to use one of these services and act like go ahead and make sure they're able to make rent, to pay their electric bill, to pay their water bill, to 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 eat food that day. And we're seeing a lot of now automated deliveries occurring. Not a lot. It's I've never seen one firsthand personal. I've seen videos of it. It's obviously the progression and where we're headed towards. It's obviously, I mean, Uber's worried about it. Uber knows its competition becomes in the future Tesla and their robo taxis, and they were hoping for a partnership. Doesn't seem like that's the way it's going. Point being that a lot of jobs that are here today likely won't be. And a lot of people throw up the solution has to be universal basic income because there's no other solution. But between where we are today and when some type of like, food rations occur, there's going to be a lot more pain, and that pain is going to spread out. And I think this puts a little bit of a highlight on what exactly it is that we do here. As far as you could see in the thumbnail of today's session, I highlighted tech, gold, and Bitcoin. And obviously our focus is on tech and on Bitcoin. And you could see it in today's market. In today's market, it is very concentrated towards tech. 40% of the indexes are made up of not only tech, but just a few tech companies. And of course, what Nvidia has done in the last 10 years is absolutely extraordinary. It's a story that some saw coming. The ones that did were likely not able to hold on the whole ride, but it's a story that is unusual. A lot of people right now might be looking, well, where's the next Nvidia? What's going to be the next Nvidia? Look, Nvidia is here right now, and we saw its earnings. By the way, it's data centers not meeting expectations. That was a bit of a surprise. The market and the way the market is handling this, to me, is a bit of a surprise. But that just again, that's another affirmation about what we do as far as knowing when to be in the markets, when out, and on what side, which is absolutely everything and more important than ever. Right now, we are in a situation where a lot of people see a lot of worrisome things in the markets, including this chart you're seeing right now. You're looking here at the inversion of the yield curve. And historically, when the yield curve is inverted, it's been on average 16 months to a recession. Now we're way past that right now. We're past 16 months, right? And here you have the first in inversion, and then it reverted. But from where it went the second time, you could see until today, we are we are well past. We're almost double what the average has been. Is something different this time. And you just know I posted a chart of gold this morning right before going live. And you can see gold right here this morning is on the verge of breaking out to the upside. It's into that resistance right now. What's interesting about this chart that we're looking at is that gold since April has been tremendously overbought and has been able to consolidate during this overbought and now potentially even moving out. Gold has never been this overbought for this extended period of time before. And that's different. There are a lot of people looking towards well, this was came up in the comments yesterday. And it's probably one of the most important things to answer. When we talk about this time being different, I'm saying that it is different than the last 40 to 60 years. Obviously, that should be clear to most of you through the bond going through this, this mega super bull market and now entering into a secular bear market. That's different. That's not the same. A lot of people are using the same playbooks that they've been using for the last 40, 60 years. Now, it it's the same. Lynn Alden pointed this out. It's the same as it was back into the last time we were in a similar situation of debt to GDP back in the 1940s and when fiscal dominance was paramount. So it's not that it's different. It's the same as it was the last time. It's different than it's been. Yeah, look, again, gold has never, since being depegged in 1971 from the dollar, it went through that major hype phase when it happened as well, right? You could see that gold's depegged and mega bull. We talked about this yesterday. Facing reality stage, the spot ETFs goes through a mega bull. It's been consolidating since, and now it's off again. It's being repriced in real time, and the reason that it's being repriced in real time, it's because it's a neutral asset. No longer is the U.S. Treasury the market of choice, and reason being is because of the sanctions that were weaponized. And you could see that Russia was the first, after being sanctioned, that they decided that, well, we're gonna divest of all our treasuries, and we're gonna start stacking gold. And then China said, you know what? That's a fantastic idea. We're not completely divesting. We're not continuing to up our purchases, and actually we're winding them down, but we're stacking gold as well. And gold's, that's different. That's not the same. So when we say, is this time different than what? I think that providing that context is really important. So is it different? Well, it's different than it's been in the last few years. That's for sure. Which also brings up this really important chart that Luke has shared here with us this morning. So we're looking at the inversion, the reversion of the yield curve, and we're not seeing markets collapsing. Interesting to talk about whether or not the inversion is similar or different compared to both 2000 and 2008. We'll be getting to that in sessions ahead. Right now, we're looking at a lot of complacency in the market. VIX is at a very low level. Markets continue to rise, and a lot of people worry that that's usually what happens right before a crash. And again, a lot of people are looking for where exactly that crash is coming from. Dollar is really weak right now, and in a situation where the seasonals are very strong for the dollar. So I think that's very important just to recognize that normally from the beginning of the summer, and I could say, well, we're only a couple of weeks into, a few weeks into the summer. Let's see what happens September, October, and into November. No doubt. But if the Fed, and we don't know, we're the ones who are kind of, almost 50-50. Markets leaning towards a cut in September. Still after today's GDP, still after today's favorable unemployment claims, still heavily pricing in that cut. But tomorrow is core PCE. So that potentially could offer some type of surprise. If it comes in very hot, maybe that's something that would, we could see those odds definitely balance out a little bit more. Not really sure. Boom, boom, boom. I mean, as far as long in the VIX though, we all know overbought and oversold could remain so for a really long time. And I think that today, and just focusing in on gold is a tremendous example. And you could see that again, gold was way overbought over here when it reached 27 $2,700 an ounce. And then it had a minor pullback, and then here it is since, and it remains for 6 months overbought and looks like it's potentially breaking out, headed higher right now. So you have to be careful when it comes to overbought and oversold. Usually oscillators work until they don't. Something to watch out for. By the way, interests are higher than they were off of Powell's pump, Jackson Hole. Markets shooting up and then consolidating since, and are at their highest price point since. We are seeing, obviously, a lot of people speculating out further down the curve as we continue to see alts here very favorable. A lot of people are worried about what comes next as far as seasonals and September. I think we'll come into that in a little bit. I want to finish what or begin what we're talking about now. And again, when we talk about here, the collapse of America has begun. I want to present it in the context that a lot of, which is so true, and we've often talked about these slow motion train wrecks. It's more dangerous than something quick. Any type of quick crisis is going to be addressed by the authorities. I like the use of the word authorities here, right? The central planners. They have no choice but to keep the music on. They can't let it end. They'll do whatever it takes, and obviously we've seen it all before. And any type of quick crisis generally leads to also a quick resolution, and we've seen it before. This is why coming out of a crisis, out of panic cuts, fast forward a year later, and it's the most bullish of outcomes because the liquidity had to be addressed. I think a slow motion collapse is the worst because most people don't see it coming until it's too late. And this is a really strong reinforcement for what we do here together through the collective hive mind, through CTM, through offering the ability here to know when to be in the markets, when out, and what side. And I mean that, look, I don't know what happens next with Bitcoin. I'm very clear and very detailed about the bullish case for Bitcoin, what my projections are going forward through the 2028 halving, but you never know what's going to happen. And having the ability to lean into something like Bitcoin bull market, uh, Bitcoin bull runs, right? If anytime that goes out of the market, that's suggesting that likely you're going to see further downside pressure and momentum. There's no excuse if anyone wants to protect themselves from what could be a bear market not to be on the right side, right? So that's very important. Same thing here with what we're looking at. I mean, you've seen it really displayed recently with Ethereum. I mean, people went through some really tough drawdown throughout 2024. And then all of a sudden, why people had given up on Ethereum, you could see the algo taking really like a series of nice trades off of the bottom. We continue to see and be holding TQQQ right now. Tesla off of that recent entry, currently under pressure right now. Everything else on the sidelines. The reason we focus in on tech is because tech is continued. Tech is there's an extraordinarily high probability that technology is going to continue to lead. There's a good reason from my standpoint of why we see such a high concentration of tech within the markets today, bringing in the money. By the way, NVIDIA's warning flag that we saw yesterday, I just want if we see that occur from Microsoft or Meta going forward, that for me would be the big red flag. Earnings next quarter, Meta and Microsoft are the most important thing that I'm going to be watching. But tech, I think for a very good reason, is so concentrated in the indexes today because tech is the one that is producing the big money, the big earnings over here. And I expect that that's going to continue. Nevertheless, you don't know. I mean, I think we all look up to some of the great minds like Stanley Druckenmiller. Stanley thought that 2 years ago we were likely headed for a lost decade. And you've seen over the last 2 years markets up and to the right. Even the greats, even the greats and some of the smartest minds have a very, very, very tough time being able to, let's say, invest around their ideas of what they expect to happen. What we do here is giving the people the opportunity to not only survive, but thrive going forward. More important than ever. I don't know whether or not tech is going to continue this crack boom that it's undergoing, as well as the equity markets, or they're going to crash, or they're going to enter into some type of what is deemed a loss happen. But I know how to position regardless of what's happening. A lot of people today, and rightfully so, are pointing to a lot. You could look around you and you could see a dozen or more reasons to think that tomorrow there's going to be an imminent collapse. I like being informed of everything. It used to be Stansberry Research, or maybe it's Stansberry Research now. Danielle, Italian or something or other. She did a recent piece on someone presenting the, let's say, the mega $5.2 trillion fraud taking place within the municipal bond market. And it's you should watch it. It's a fantastic piece. You should be aware of it. But do you remember what happened with Dr. Michael Berry? Burry? Sell! That was probably the worst call I've ever seen in the markets. By the way, Jim Cramer named it. Yeah, he was right about the housing market collapse, but he almost blew out his fund and was wrong. You've seen The Big Short. You know that he was positioned for what was the right trade, but it takes a lot longer than people expect in order to actually, let's say, blow up. And I think a lot of people intuitively right now are sensing that things are not right around them, because they're not. They're not at all. And by the way, I want to remind you all that as people are looking for that collapse, I guess we should get to Luke right here. So Luke is pointing out something that I think is tremendously more important than this. This is, a lot of people look at the 2 and 10 year and the curve here, and I think that Luke discovered something that is much more high signal than the 2 and the 10. He's looking at the 3 year, and I think the 3 year provides a really good balance between the 2 and 10 year, where it's able to price in what current Fed policy is expected to be, as well as future inflation expectations. And Luke is pointing out here that, you know what, we have to be very careful. If, like I don't care what the narrative is, we cross the red line and I'm looking to de-risk down. And why would he say that? Like, for what reason? You guys showing up each and every day and putting the work in is unbelievable. I'm grateful for each and every one of you. And Hunter, thanks for being here. Great to see you. Great morning, Brad. Great to see you, Omicron. And what Luke is pointing out is that this could be bad news bears, and I don't want to get caught off guard. Obviously, markets here are extremely elevated, extremely elevated. I don't know, overvaluation. Is that what we're going to call them? I wonder, and I think about whether or not, value. A lot of people talk to, I'm sorry for going dispersed here, but I want to get a lot out. A lot of people talk about things like the trajectory of M2, the amount of cash that's being held in money markets, the amount of cash that commercial banks continue to grow into the system. And like, that's always going to rise. And the reason there's more money today in the money markets than there were 10 years ago and 20 years ago and 5 years ago, the same reason there'll be more 5, 10, and 50. It's the only way to keep the system going. But we've looked at, and I think it's just, I don't know, here we are. But let me just briefly bring up M2. And the reason being is because, yeah, you could see worldwide right now that the like money creation is happening. A lot of people think that that means risk is going to continue to rise, and it could very well mean that. But the problem with that, and I just want to really point it out, is that anytime the markets have actually crashed or gone into a bear market, that money creation continues going up and to the right, and there's an extreme lag on it. It's a very bad indicator. It's not something we could use. So I guess I'm pointing out, the what works and what doesn't. And Luke here is looking at something and highlighting something that might be really high signal to be paying attention to. And I'm looking at it genuinely, right? And I'm just going to start over here, and we have the recessions marked in these highlighted areas below. And you could see during the 2008 recession, the massive correction, the massive correction. This one came after the recession, nevertheless, as well as this one over here. I'm looking, and you can see the vertical line. Let me go ahead and match them up. All right. So I'm looking at the breakdown occurring right over here. And it's actually after the recession. Well, that's not important. We're not concerned about when they actually designate a recession or not. We're more concerned with what the price action is, right? Being on the right side. And of course, that's why we have the moats. But you could see a breakdown of the 3-year right over here. Or if you had it horizontal, you could see breakdown retest. And if you were looking at the horizontal, you were late. There's no question about it. And when I say you were late, if you look down at the S&P 500, you could see that's close to where it bottomed and leveled out. But if you use some CTMTA, right, and you can see that breakdown right over here, still a little late. So I'm gonna, instead of giving this particular instance a check mark of a breakdown, I am gonna give it an X. And I was trying to not do that there. Here's a big breakdown, right? And this would be pretty early, I think. I think that's a good breakdown. And maybe if you did it better, like Luke is doing, you could see some really strong TA over here. Luke is doing it well. I'm going to go off of not what happened in real time, but what could have been the best opportunity for a breakdown. And right over there, you could see it. And there was a small scare. Look at the price of the S&P 500, 1998. It corrected 20%. It's a big correction. 20% is a big correction. It just happened in April. Markets corrected 30%, right? But it was very quick. It wasn't something that was lasting, even though we had that major breakdown. So I'm going to fast forward then. And this is very clean and clear. And here's a breakdown. And that led to an extreme correction in the markets and long lasting. And that signal was completely on point. Luke, I hope above all you're appreciating this. And because I'm just looking at it from my vantage point. I surely enjoy yours, which is why we're here spending time with it together. I think it's absolutely fantastic. And then over here we have the 2020 crash. Now, this is a trend line break. That's a little early. I don't know. I wouldn't have been able to really have. Is that an underbelly? Maybe. And that a breakdown. It led to it. That would have been very difficult to do. Been very. Yeah, I mean, fourth turning. We're seeing fourth turning things happen all around us as we watch the let's say I don't know what to call it, the neutering of the Federal Reserve. That's also different right now. So Luke, and I don't know right now whether this is coiling up and could break. Let me look at your chart over here. I don't know if this is coiling up and getting ready to break out to the upside or break down, or even if we do break down, whether or not we have a liquidity grab. I think that there's every reason to be cautious here. I just don't know how to exactly, yeah, for me, it's much like a lot of things we look at, including the blood indicator. Sometimes they work, other times they don't. And that's my view of this. I think it's something to really be watching for. As I look around, a lot of people are very, very adamant that we are like about, and I don't, this is not Luke. Luke is just he's pointing to the charts, he's pointing to the data, nothing else about it. A lot of people, though, are speculating that within, you know, the fall, we're about to experience a collapse. I don't I don't believe that's going to happen. Now, if you start seeing like collapse in my headlines, we're going through a collapse. We're going to make sure that we are be able to react accordingly to protect ourselves. No question about that. Including if I say to you, this is not supposed to happen. This is a de-risk event. I don't care what my projections were going forward. You have to understand that anytime I've said that before, all I could say is anyone who didn't listen wishes they did. That's all I could say. You know. Um, let's continue looking over here and continue this conversation and find a way to bring it in. Bitcoin right now continues to be well within what I deem the sustainable channel. Now I do believe that Bitcoin tech, which is why we focus on Bitcoin. We focus on crypto, right? We focus on Ethereum, Solana, Cardano. We focus on being able to trade these instruments in order to be able to produce either more money for trading, for fiat. Yes, we live in a fiat world. We have no problem with using fiat as a tool, and in many cases that's continued to stack more Bitcoin. And probably I know that we did a fantastic job in calling out the super cycle. That's what we called it. I called it at the time. The super cycle in gold breaking out. But even though I said that, listen, we're not going to stop at 2,700 and I'll see you at 5,000. I don't believe that I've done enough of a good job of making the case of why gold is so important. I don't believe I did that. I think I did a very bad job. And part of the reason was because, well, I have this bias that I believe that regardless of what gold does here, that Bitcoin is going to continue to appreciate against gold. And in, 5 years from now, 10 years from now, the amount of appreciation that Bitcoin continues to make versus gold is going to be, I think, pretty substantial. And we look at the $22 trillion gold market, and Bitcoin's a $2 trillion market, and it's growing rapidly. And I suppose that's why, but nevertheless, you never know. I think I could have done a better job, let's say, as far as, but the other reason why is because I also didn't really understand what was happening. And I think that this is a great chart to bring up and show you. And in so much as that we looked at this chart from the past, like the 2018 top of Bitcoin. And I want you to see over here. I'm going to zoom in over here. Here's the top of Bitcoin. I'm going to line gold and Bitcoin up from when they top. And I want you to see something. And you can see that mega outperformance when Bitcoin tops, because Bitcoin undergoes an 85% correction. And even though gold is correcting or going sideways, not nearly as much as gold, right? And then you can see the recovery of gold. But what I want to point out is over here. I'm going to go forward a little bit. I'm keeping on the left off of the high. And then you could see that this is after the printing, and gold continues to roar. Bitcoin's lagging a little behind it. Gold leads, then Bitcoin follows, and then hold on, let me come back to right here at this point. Once once you're able to see in the past, gold blow past gold, Bitcoin blow past gold. the ascent has been tremendous, right? A tremendous ascent. I mean, in the appreciation, and I'm trying to line it up as best as possible, but is dynamic. And this time, I'm going to go off the high now of 2021, right? And this time is different. This time, when you're able to see gold, Bitcoin make the new all-time high versus gold, which is going to be in March of this year, and it starts blowing past it. Oh, there we go. It starts blowing past it. That's when it stops. And gold and Bitcoin since then have been moving up almost in unison. Almost in unison. And what I didn't realize is happening here is something different. So we talk about, is this time different? Well, yeah, it's different, and it's always going to be different, right? And there's been a lot of things in the past that were the same, but guys, there's nothing similar to what's taking place today as to took as that took place before 2008. And after 2020, everything is different. And the most significant thing that's different since 2020 is right here. And it's the gold market and the bond market. And the bond market has entered ever since 2020 into this massive secular bear market. Now, if you look at the 10-year today, it looks like that, yeah, it thinks that potentially the coming cuts are good for the economy and it likes it. And it begs the question right now. Let me just go ahead and check what the probabilities for the September cut are right now and how much they've changed. I mean, pretty much the same. They're heavily priced in now. That is definitely dynamic, and I don't know which way they're going in September whatsoever. I would be equally like not surprised if they cut 3 times this year or they didn't cut at all. That's exactly where I am as far as what my expectations are. Nevertheless, we have to watch, and I think all eyes are watching what happens to the 20 30 year, the long term, when they do cut. Are they going to wind up selling off? That's what a lot of people expect. Maybe they don't. you know are we seeing signs as the market is looking to price in some further cuts, that actually maybe that it's variable? I don't know. That it's very difficult, and such an important point. As the Fed begins cutting, are they cutting into normalization? Are they cutting into recession? Are they cutting into a panic? As well as, that's an important reference point to see how markets react. We all have ideas about what our expectations are, but we never know. And that's the important part of being able to play out what the different outcomes are. Not saying, I think there's going to be a market crash in the next 2 to 3 months. Not saying, I think there's going to be a bear market in 2026. Well, okay. Like, why? Very important. A lot of people thought, coming back to late 2022, remember when we called the breakout of Bitcoin's bull market? Remember we called the NASDAQ melt up? Everyone was macro bearish beyond belief at that particular point. Not everyone. Luke pointed out that cross-border capital, Michael Howell, was November 2022, turned bullish because of liquidity. And that's an important reference point, because he's turning very bearish 2026. He's pointing to that we're about to see the liquidity tide rush out and turn very bearish. Now, I think it's very important to look at in 2000 and in 2008, which were both market crashes, and even with the rise in liquidity, they crashed. And then I think it's an important piece to just have in our minds here as we look at what's taking place with the gold market, the bond market. Something is different, right? It's not like, oh, you're calling this time is different. No, this time. And then we talk about the idea of fiscal dominance. Now, it does seem that we're seeing almost a turn here, where monetary policy is loosening, potentially getting ready to loosen a little bit, even at as what may be, let's say, a lesser dominance of fiscal dominance in the year ahead. But we are seeing at a time that monetary policy is expected to loosen. So it's dynamic. I listen, the 4-year cycle is proved to be a great opportunity for us in early 2020 to position into markets at a very opportune time. You know, it's dynamic. It could change. I want to make sure that regardless of what happens, that we're able to do our best to navigate these markets. If you would have asked me today after Nvidia's earnings, I didn't think Nvidia's earnings were good at all. I thought they were very bad, and in so much as that, but here we are, and Nvidia is only down, 1.5%. Anyway, are we looking at seasonalities? And sure enough, we were looking for the bump the last week of October. I said it Friday. I said it Thursday before Powell. Is Powell going to ignite a run up through the end of next week, which we find that is faded down into and through September? And it's not just then. We also have to think about and talk about, I'm hiding price over there, through the post-election year. We do have weakness through the end of October. By the way, Cabby came out with this idea this morning. I'm going to go ahead and make sure I implement it, throwing out like a community indicator strategies, not CTM strategies, not our templates, but one where people within CTM could post their creations to the community. I think that's a fantastic idea. Make sure we go ahead and opportunity. So I think GameStop made a fatal mistake in so much as raising money with the belief that what it was going to do with it was stack a tremendous amount of Bitcoin, and it was at a very low price. It was sub $80,000, and instead they bought $500 million worth retail. And I don't think that people that were looking to speculate in GameStop, I think that put a sour twist into their mouth. And probably like a lot of those funds are now going towards things like, let's call it Bitmine. By the way, Ethereum here a little bit shaky right now as you look at Ethereum here testing a pretty important sell impulse line. Keep an eye out over there. $60 billion worth of buybacks. It's a tremendous amount of money, no doubt. The question was it enough? Was it enough? And then, I heard, not during yesterday's call or anything like that, but in the last week, Jensen saying that, listen, we're not paying anyone a percentage of our revenue without, going to court over it. Could we have some type of friction between the president of the United States and Nvidia? Never know. China right now though is booming, and I think that is conducive to risk. We've been looking at, of course, the UK bond market, of course, the Japanese bond market. Both of those, a lot of people think right now are towards potential or at crisis levels. We look at the US bond market, but it turns out a lot of bond markets in Asia right now are extremely healthy. It's tough to navigate. I think it's going to get hard. Why I'm making or highlighting just the importance of what we do here, because if you're actually like ingrained in CTM and you are not executing mechanically and with discipline, you got to get there now. I don't, even if they're able to continue running this thing hot, even if this rally extends further, even if we see something like, right, the 2000 and 1998 analog, and you can see how well they 2 years back to back 20% plus gains, 20% correction, 30% correction. Out of it, they're the same. Even if we come into some type of mega bull and blow off, right? Remember, again, Stanley Druckenmiller, he got wrecked during the dot-com bubble. He just didn't know what it was. Why? Because it was different. It was new, right? Stanley Druckenmiller sold NVIDIA. He was early into NVIDIA. He sold it early as well. It's very difficult. Markets are extraordinarily difficult. And if something like this were to be similar going forward, that's my worry is when that growth comes to a slowdown and inflation then is going to be much higher. Inflation ticking up now is not a problem. Inflation over 4% becomes a problem. And when inflation gets higher and then when the growth actually slows down, that's when I'm worried that it's going to be an absolute disaster. Anyway, everyone, let's keep it light and sweet today. Let's continue at it tomorrow. Thanks for being here, everyone. Have a great day. God bless you. And I'll see you all back today on the inside.